This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. Every support and resistance line you have ever drawn was a guess. A horizontal line snapped across a couple of highs or lows, hoping price respects it again. Sometimes it works. Sometimes it does not. And you never really knew why. What if I told you there is a tool that removes the guessing entirely? A tool that shows you the exact price levels where the most shares actually changed hands, where the real money is parked, where institutions have the biggest positions to defend, not where price touched, where price traded, with size. That tool is volume profile, and the single most important level it produces is called the point of control. In the last lesson you learned VWAP, the one line Wall Street trades around. Volume profile takes that idea and blows it wide open. Instead of one average line, it gives you a complete horizontal map of the entire market, every price level ranked by how much volume traded there. It is the closest thing to an X-ray of institutional activity that exists. By the end of this lesson, you will know exactly what volume profile is, what the point of control means, and why price is magnetically drawn to it, how to read the value area, how to trade high and low volume nodes, and how to use the naked point of control as one of the highest probability targets in all of trading. This is where AI stocks are really being traded. Let us map it out. Let us start with what volume profile actually is, because once you see it, you cannot unsee it. Every chart you normally look at plots volume along the bottom, as vertical bars, one for each day or each bar. That tells you how much traded over time. Useful, but it is missing something huge. It does not tell you at what price all that volume traded. Volume profile fixes that. Instead of plotting volume horizontally across time, it plots volume vertically across price. Picture taking all the trading over a period and sorting it, not by when it happened, but by the price it happened at. You end up with a sideways histogram running up and down the right or left edge of your chart. Each horizontal bar shows the total volume that traded at that specific price level. Long bars mean a huge amount of volume changed hands at that price. Short bars mean very little traded there. Suddenly the chart tells a completely different story. You are no longer looking at where price has been over time. You are looking at where the market has agreed on value, where buyers and sellers did the most business, and where they barely showed up at all. Those long bars are not random. They are price levels where institutions built positions, where enormous amounts of capital changed hands. And here is the key principle of the entire lesson. Price remembers where volume traded. The levels where the most shares changed hands become the most important support and resistance on the entire chart, because that is where the most traders have a reason to defend their positions. Now let us talk about the single most important level volume profile gives you, the point of control, or POC. The point of control is simply the price level with the highest traded volume of the entire profile. It is the longest bar on the histogram. It is the one price where more shares changed hands than any other. Think about what that actually means. The POC is the price the market agreed on the most. It is the level of maximum acceptance, where the greatest number of buyers and sellers found a fair deal. And because so much business was done there, it becomes a powerful magnet. Here is the behavior you will see over and over. When price drifts away from the point of control, it very often gets pulled right back to it, like a rubber band snapping back to center. Why? Because that is the price everyone agrees is fair. When price gets too far above the POC, sellers see it as expensive and step in. When price gets too far below, buyers see it as cheap and load up. The result is that price gravitates back toward that high volume level again and again. For a trader, this is gold. The point of control gives you a high probability target and a decision point. If price is above the POC and holding, that is bullish acceptance of higher prices. If price is below the POC, that is bearish. And when price approaches the POC from either side, you watch closely, because that is where the market has historically done the most business, and that is where the next big battle is going to be fought. On a stock like Nvidia or AMD, marking the point of control tells you instantly where the institutional line in the sand really is. The point of control is the single most important level, but around it sits an equally important zone called the value area. The value area is the price range where roughly 70% of all the volume traded. It is the fat middle of the profile, the region where the market spent most of its time and did most of its business. The value area has two edges. The top edge is called the value area high, or VAH. The bottom edge is called the value area low, or VL. Together, the value area high and the value area low define the zone of fair value, the range the market has accepted as reasonable. Everything inside that zone is considered fair. Everything outside it is considered expensive above or cheap below. This gives you an incredibly powerful framework. As long as price is trading inside the value area, the market is in balance, and price tends to rotate between the value area high and the value area low, bouncing from one edge to the other around the point of control in the middle. That is a range trading environment, but the real signal comes when price breaks out of the value area. When price pushes above the value area high and holds, the market is accepting higher prices, and that is a bullish sign that value is migrating up. When price breaks below the value area low and holds, the market is accepting lower prices, and that is bearish. The edges of the value area become your key decision levels. A rejection at the value area high tells you sellers are defending fair value. A breakout and hold above it tells you buyers have taken control and are willing to pay up. This is how professionals frame a chart. Point of control in the center, value area high and value area low as the boundaries, and price either rotating inside the range or breaking out of it. Now let us go one level deeper and talk about the shape of the profile itself, because the bumps and the gaps in that histogram tell you exactly how price is going to move. The fat parts of the profile, the long bars, are called high volume nodes, or HVNs. These are price levels where a huge amount of volume traded, where the market spent a lot of time and did a lot of business. And here is the critical behavior. Price sticks at high volume nodes. Because so much volume is parked there, these levels act like magnets and like walls. When price moves into a high volume node, it slows down, it chops, it consolidates. These are your strongest support and resistance shelves on the entire chart. The thin parts of the profile, the short bars or the gaps, are called low volume nodes, or LVNs. These are price levels where very little volume traded, where the market passed through quickly and did almost no business. And their behavior is the exact opposite. Price moves fast through low volume nodes. Because there is nothing there, no positions to defend, no agreement on value, price slices through these zones like a hot knife through butter. This is one of the most practical things volume profile gives you. When price breaks out of a high volume node and enters a low volume node, expect a fast, sharp move to the other side of that gap, all the way to the next high volume node. Think about how you can use that. Your entries and your support and resistance come from the high volume nodes, where price sticks. Your targets come from riding through the low volume nodes, where price accelerates until it reaches the next high volume node, where it will likely stall again. On the fast-moving semiconductor names, spotting a low volume node right above a breakout level tells you that once price clears it, the move could be explosive. Quick pause. If volume profile is starting to click for you, do me a favor and hit that like button. It takes 1 second and it genuinely helps the channel grow so I can keep putting these lessons out for free. Subscribe and tap the bell so the next lesson lands in your feed the moment it drops. And if you are building your career while you build your trading skills, check out Resume Zenith. Professional resumes that actually get you noticed and get you interviews. Link is in the description. Alright, now let me show you one of the highest probability setups this entire tool produces, the naked point of control. This is the setup that is going to make this whole lesson worth it. The naked point of control. Remember, the point of control is the price where the most volume traded, and price is magnetically drawn to it. But here is the special situation. Sometimes price forms a point of control, then rallies or sells off sharply and moves away from it, and it never comes back to test that level. When a point of control has not been revisited by price, we call it a naked point of control, or a virgin point of control. And a naked point of control becomes one of the highest probability magnets and targets in all of trading. Why? Because the market has unfinished business there. That level represents a price where enormous volume traded and price walked away without retesting it. Over and over, price comes back to fill that gap, to tag the naked point of control before it continues on its way. So how do you trade it? First, when you see price trending back toward an untouched point of control, you can use that level as a high probability target for your existing trade. If you are long and there is a naked point of control above, that is a logical place to take profit because price is likely being pulled toward it. Second, the naked point of control itself becomes a reaction zone. When price finally tags that level, watch for a reaction. Very often price hits the naked point of control and then reverses because the level did its job. The magnet has been satisfied, and now the market can decide its next direction. So the play is, use the naked point of control as your target on the way in, and then watch for a candle-based reversal signal when price actually reaches it. Combine that with everything you have learned. A naked point of control, lining up with a key support level, a bullish reversal candle, and confirming volume is an A+ setup. That is how you turn a heat map of institutional activity into precise, high-probability trades. Let me show you how to get this on your charts right now using TradingView. The good news is the core tools are available even on the free plan. Step 1. Open your chart. Pull up NVIDIA, AMD, SMH, whatever you are trading. Step 2. Click the Indicators button at the top and search for the words Volume Profile. You will see a few options. The two most useful are Volume Profile Visible Range and Volume Profile Fixed Range. Step 3. Start with Volume Profile Visible Range. When you add it, it automatically builds the profile for whatever price data is currently visible on your screen. Zoom and scroll, and the profile recalculates for that view. This is perfect for quickly seeing the point of control and value area for any swing you are analyzing. Step 4. For pinpoint work, use the Fixed Range tool. It lets you click and drag to select a specific range, for example from a major swing low to a major swing high or across a single consolidation, and it builds the profile for exactly that segment. This is how you isolate the point of control of one specific base or one specific move. Step 5. Open the settings and make sure the point of control line and the value area are turned on and clearly colored. Set the value area to 70%, which is the standard. I like to make the point of control a bold, bright line so it stands out, and shade the value area lightly so I can see the boundaries at a glance. Step 6. Use the profile to mark your levels. Draw a horizontal line at the point of control, at the value area high, and at the value area low. Now you have a professional-grade map on your chart. That is the whole setup. Visible range for quick reads, fixed range for precision, and your key levels drawn from the profile itself. Before we wrap, let me save you from the 3 biggest mistakes traders make with volume profile. Mistake number 1. Profiling the wrong range. Volume profile is only as good as the range you apply it to. If you throw a profile across a random chunk of chart with no logic, you get a meaningless point of control. Always anchor your profile to something that matters. A complete trend from swing low to swing high, a consolidation base, or a specific session. The range defines the story, so choose it deliberately. Mistake number 2. Treating every level as a hard wall. The point of control and the value area edges are high-probability decision zones, not laser-precise price points. Price may wick a little past the value area high or poke through the point of control before reacting. Think in terms of zones, not exact pennies, and always wait for confirmation, a candle reaction, a volume shift, before you act. Do not just set a blind limit order at the exact level and hope. Mistake number 3. Using volume profile in isolation. I say this every lesson because it is the difference between guessing and trading with an edge. A point of control means far more when it lines up with a VWAP level from the last lesson, or a horizontal support and resistance zone, or a candle pattern from phase 1. When your naked point of control sits right on top of a key support level and price prints a bullish engulfing candle there on rising volume, that is not a coincidence. That is confluence, and confluence is where the highest probability trades live. Volume profile shows you where the market did its business. Your levels, your candles, and your other volume tools tell you whether the setup is actually worth taking. Stack them together. Time for your homework, and this one will genuinely change how you see charts. First, open TradingView and add the volume profile visible range indicator to the daily chart of NVIDIA or AMD. Identify the point of control. Where is the longest bar? Is price currently above it or below it, and what does that tell you about the bias? Second, mark the value area high and the value area low. Is price trading inside the value area, in balance, or has it broken out above or below? Third, look at the shape of the profile. Find a high volume node and notice how price stalled and chopped there in the past. Then find a low volume node, a gap in the profile, and notice how fast price moved through it. Fourth, and this is the big one, scan back and find a naked point of control, a high volume level that price shot away from and has not retested. Is price heading back toward it now? Mark it as a potential target. Fifth, use the fixed range tool to profile one specific consolidation base and find its point of control, then watch how price reacts to that level going forward. Write down your complete read, the point of control, the value area boundaries, any naked point of control targets, and your prediction for the next move. The full volume profile cheat sheet, including the setup guide and the naked point of control playbook, is available free at candlelogictrading.com. That is lesson 18. You now have a tool that turns support and resistance from a guessing game into a map of where the real money actually traded. Let me recap. Volume profile plots. Volume by price instead of by time, showing you exactly where the most shares changed hands. The point of control is the single highest volume price, the level of maximum agreement, and price is magnetically drawn back to it. The value area, bounded by the value area high and the value area low, defines fair value and contains about 70% of the volume. High volume nodes are shelves where price sticks. Low volume nodes are gaps where price moves fast. And the naked point of control, an untouched high volume level, is one of the highest probability magnets and targets you will ever trade. Never use it alone. Stack it with your VW app, your levels, your candles, and your volume tools for the best setups. Now here is where the next lesson comes in. Volume profile shows you where the market has traded historically, the map of value. But it does not tell you which stock is exploding with unusual activity right now, today. What if you could scan the market and instantly spot the one stock that is trading with 2, 3, 5 times its normal volume before the big move is over? That is exactly what Lesson 19 is about. Relative volume, or RVOL, how to find the stock that is about to explode today. It is the tool that tells you where to point all of this analysis in the first place, and it is how professionals find the plays that actually move. You do not want to miss it. Subscribe and hit the bell. New lessons drop every Tuesday, Thursday, and Sunday. Smash that like button if volume profile just clicked for you. Share this with a trader who is still guessing at support and resistance. And leave a comment telling me the point of control you found on your favorite stock. Go practice, protect your capital, and I will see you in Lesson 19. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.